Hello ladies and gentlemen, and welcome to the latest edition of the True Potential Do More With Your Money podcast. I've been joined today by the A team. I don't know which one's B.A. Baracus.
Looks like Tom, he's got the beard.
Tom's got the beard, yeah. We'll shave the mohawk anyway, Tom. So we've got Tom Robertshaw, one of our financial advisors, Dan Harrison, Chief Executive, and we've got Sophie, one of our team leaders in the customer care team. So we've got a good mix really of hopefully knowledge to run through today's session, but we're basically going to spend the next 25-30 minutes talking about the tax year end. It says here mistakes you must avoid, so we'll probably use that throughout the session to look at what to avoid, but also what to do. And I think I wanted to not kick off literally, but talk about probably my biggest bugbear is that we call it a tax year end. An end sounds like it's a deadline, something you need to meet, but actually the tax year exists for the whole year, doesn't it, Tom? It's kind of really, you speak with clients all the time, giving advice and so on, and I just wanted to sort of start, and it's not Graham's fault, but we've got the heading there, tax year end, and people think, well, I've got until then. There's a lot of benefit to just actually getting in early, isn't there? Yeah,
absolutely. I mean, it's more of a reset, isn't it, more than anything, and it's just a chance for allowances and exemptions to end, and it's really, really important to get it all sorted before the end of the tax year, but fortunately people do often leave it right till the end, which you going into the new tax year with it being so, if you have left it to the end, I would strongly suggest that into April you get it, those allowances used up again early on, so you don't forget and don't leave it too close to the end, because it's not something that clients should be really doing.
No, and I guess we'll probably get into this, Greg, Sophie and Tom, as the questions progress. But yeah, tax year starts a much better way of looking at it, because the benefits of the allowance and the tax benefits you get from there, having a whole 12 months of those allowances and the growth is far superior to almost waiting now till the end of February where we are and saying exactly what you're saying. So I better use my allowance up now, because potentially you've missed a year's worth of extra growth with the great tax benefits, which I can see from the questions Tom and Sophie are going to help us with today.
Hopefully they're going to help us too. I think it was described earlier that we had the young side and the old side. Is that right, Tom?
Yeah, that's what I said.
Being a little bit ageist against Dan and I. So
we'll get our own back at some stage.
No pressure. Well, look, I think if we probably just kick off with some of the questions, again, thanks to all of our listeners, viewers, clients and the like, where we get a great amount of questions coming through, so many actually for this Q&A session that we've condensed some, so we haven't got names against the questions, but we've kind of collated them all and come up with a question. So quite an easy one. This might answer everything for us, because I thought this was a good question. But why does tax year end matter, and what should I be doing? So Sophie, if I was to ask you that question, what would you say to why does it matter, and what should our clients be doing right now?
Yeah, it's really to make the most of the allowances and the tax efficiencies that you can get in the tax year before the new one begins.
Yeah,
that's essentially why it matters. Like Tom said, you've got all year to make use of these, but I sometimes leave things to the last minute, and so do a lot of our clients. So I think it's that reminder of, I haven't used this allowance, or if I move this here, it could be more efficient for me. So it's just, taking advantage of that before that's lost and we move into a new year, so that you can continue to do the same next time.
Yeah. And have we noticed maybe an increase in calls and volume coming through from clients and questions? Because you both are on the sort of the front line, so to speak, with our clients. Is it something we're starting to see?
Yeah, it always is, and there's actually some seasonality in it as well. You'll always see it this time of year. The number of advisor calls that we have, and sort of your customer care calls as well, they'll go certainly up, and then they'll drop off at the end of sort of April really. But that's just to be expected in any sort of financial business really. And I think one of the things that I'd just like to sort of say if this tax year more than any tax years is we've got some allowances which are dropping next year. So this year it's even more important to use them up effectively. You've got we'll come on to in a second with the different changes that we've seen in the autumn statement. It's really important, especially for the likes of general investor accounts, to be utilising those ISAs and moving money across this tax year.
And I know you're the question master, but just to link on with what Tom's saying there, is it right, Tom, Like, if you don't make the most of your allowance in a tax year, you lose it.
Yeah, effectively, obviously, you lose it for that year, and you'll get the for instance, the ISO allowance, you'll get the new £20,000 again, and for the annual allowance, you'll get that again next year. But
so if you don't invest £20,000 in your ISA
That's
before April,
yeah.
you lose it for good.
Yeah.
It's not as if you can go £40,000.
No, unfortunately
Yeah,
not. Yeah,
yeah.
exactly.
Yeah.
Well, jumping into the question, Marston, I think one you might be able to answer, Daniel.
Might.
When is the tax year end? When does it reset? Because I think reset was a great term used by Tom there, which is it doesn't stop, it just resets into a new year. When?
Beginning of April.
Yeah.
Yeah, so Sophie, for the £24,000 question, £5 question, which date in April?
So the new one begins on the 6th.
The 6th. So you've got until midnight on the 5th.
Midnight on the 5th.
Yeah.
And
So
I
we're
actually
skirted around quite
you
nicely.
dodged that
Yeah.
one. I was actually talking to one of our sort of one of our investment team, and this was maybe a couple of years ago, and I asked them the question, when's the deadline? And obviously it's a minute before midnight it resets, and I'd sadly sat up and waited a bit, like a transfer deadline day in the football, and I impulse saved at a minute to midnight on the app, and I went in the next day and I said to one of the developers, did that get in? And they were able to get the seconds as well, so I was able to contribute into my ISA for that tax year. Really sad, isn't it? But I did it right at the last minute.
Just about old enough,
Just
whereas
to kick it.
Tom and Sophie definitely are, where we still collected checks.
Yes.
And I can remember we had one of our advisors, was Savio, wasn't it? Lives down in London way. He came up, it was about 7, 8 p.m. with a check from a client. Because back then, as long as we physically had the check and could stamp it before midnight, it was allowed. Whereas obviously now with impulse save, as you say, Greg, as long as the date stamp, the audit stamp of the transactions.
It was about 30 seconds to go, and I just thought I'd give the technology a bit of a test. So, right, next question we've got in there, and this was actually a really common one that came in. I've already used my allowances, as some fortunate people can maximise the efficiencies of the tax year, but what else can I do with my money before the tax year end?
Yeah, I think there's other products out there. So if you first of all want to be looking at your ISAs and your pensions initially, because they are the most tax efficient products. But there is other products out there such as general investor accounts where they don't have that allowance, such as the ISA allowance for 20,000, and then the annual allowance, which is either the lower of your annual earnings or £40,000 a year. And there's also as well other products out there such as bonds as well that we can look at. And effectively what the point of those two products are is to feed into those ISAs and pensions in the new tax year. And the key thing here is get it invested anywhere, because you can benefit from hopefully a little bit of growth, and then you can move the funds across from those the likes of general investor accounts and bonds into your more tax efficient products in the new tax year.
Yeah, because you can do that in the system, can't you? And set it up as a parking rate.
Good input, Dan.
Yeah.
There's lots of terms, isn't there? There's bed and ISA, and I think some people call it bed and breakfast, which I never like the sound of that one.
Makes you hungry.
But you can essentially put money in one product and then get it to auto invest into another product in the new tax year, which
we
again
can do it really easily. It's dead straightforward to do with the technology.
Yeah. And I think ultimately speak to the team. If your personal circumstances, we've still got a couple of months to go, so just pick the phone up, keep the guys busy, and get on the phone. And if you want to know what it means to yourself and your circumstances, Sophie, that's what you and the team are on hand for now, aren't you?
It's super simple. But like Tom said, it is really easy. For example, to do a GIA to ISA transfer on the system. We're there to support with that if you need it. But then if there's further questions and it's going at sort of the advice side and what might be best for you, it's then really simple just for us to book you in with the likes of Tom, who can run through your personal circumstances, give you a bit of advice there, and then we can help get that set up for you.
Well, certainly probably with GIA as well, because hopefully we get some of the growth which Tom mentions, and it's probably links into what Tom was talking about with some of the budgetary changes. So if you collapse the GIA to put it into an ISA for next year, it could potentially trigger hopefully a capital gain if it's done well. If we look back to, and this is something I'm personally looking into for my own planning as well, if we look at 2022, which as we know and as we've talked about was a year which was down as well, what I'm likely going to do before tax year end is sell down some of my own general investment account, just to make the most of the capital gains savings, and then put that straight into my ISA on April the 6th
Yeah.
as well, because you might as well, we talk about how do you turn a negative into a positive, and it may sound like I'm clutching at straws somewhat, but if you do have a general investment account and there are some losses last year in your account, you might as well make the most of those losses, crystallise that, and save yourself some tax.
And you can register those losses as well with HMRC, so you can then use them to offset against future capital gains, which is a really good thing to be doing, especially with the exemption coming down to 6,000 next tax year.
Dan, you must have a good financial advisor giving you that kind of advice.
It's Tom.
I thought that was going to be the answer.
It radiates from
Just
Tom.
line up there. Right, next question as we're making our way through. So we've mentioned the 5th to the 6th, that's the reset. What's changing at the end of the tax year? Is the new tax year going to change my allowances?
Yeah, so obviously Jeremy Hunt had the autumn statement back in November, and I think broadly speaking we're expecting the spring budget to be pretty similar to what was in the autumn statement. A few things that have changed really from a tax point of view is the additional tax rate has come down to 125,140, so that'll obviously impact the higher earners, and a couple of things from may impact investments is one is the dividend allowance. So the dividend allowance is currently £2,000 per annum, and anything within that 2,000 you will not be liable to any dividend tax. That's going to come down to £1,000 in the 2023-24 tax year, and down to £500 in the 24-25 tax year. The big one really for a lot of clients is probably going to be the capital gains tax allowance, which is going to come down from 12,300 to 6,000 in the 2023-24 tax year, and then down to 3,000 in the following tax year. So, it's really important that clients are utilising those allowances this year, just with those
couldn't agree
coming
more.
down.
So I'll not get too political because I get told off Graham, but the mind boggles what the government are trying to do here. It's just completely penalising people who save money, capital gains, hurting people who have a private business with dividend allowance. How petty going from £2,000 dividends allowance, which is nothing anyway, by the way, down to that. It's pathetic for the amount it's going to raise as well.
Yeah, and the dividend allowance, obviously the dividend rates has been going up as well. Last year they went up. So they are really being punished, small business owners, I suppose. From
we're meant to be
discourage it, won't it? Discourage.
We're meant to be a country which is meant to encourage business owners and free enterprise and things like that. So you're just stinging people instantly in terms of that. But that's enough politics
I know,
for now.
I'm just pleased you pronounced Jeremy's surname correctly.
Yeah. I know, that's why I had to write it down on the side there.
You've written it down just in case, because I know his name's been pronounced in various ways on the TV.
Well, like Jeremy.
Exactly.
Right, okay, I see.
Right.
Yeah.
Not the surname. Let's move on to pension allowances, because that's, again, a big question that we've had. Number of our viewers just asking how much can I pay into my pension. So I'm going to look at you again, Tom. Sorry, I'm going to look at the young end of the table over there.
Yeah, I mean, the annual allowance is overcomplicated, to be perfectly honest. And you probably need to speak to an advisor when it comes to this. What you've got to factor into account is your annual earnings, but what we class as relevant earnings. So, for instance, dividends that we were just talking about before, they don't class as relevant earnings, unfortunately. And you can effectively contribute up to your annual earnings or relevant earnings, and it's up to whatever's the lower out of your earnings, or 40,000 effectively. Yeah. Now, one thing you've got to factor into account as well, if that is tax relief when calculating how much to put in there. So just come and speak to, if you're a head office client, come and speak to us and we'll help you out with all of that. It's not an issue at all.
Yeah. But I think, as you rightly say, Tom, with the income tax bandings changing as well, all of a sudden you're going to get a lot more people, it goes from the 150 to 125, as you say, a lot more people going in that higher bracket, which is not half going to hit allowances next year. And
more the reason to be putting money into your pension, especially if you earn between 100,000 and 125,000, 140, you're in what we class as a personal allowance trap.
Yeah.
So it's an effective rate of 60%.
Yeah.
So if you can make pension contributions, that'll bring your adjusted net income down and really help you out there. And it's good tax planning.
No, I was asked about some of this in a Daily Express article, and I think it's going to affect up to about 800,000 extra people who are just going to move into that trap, as you say, Tom, and it just doesn't get spoken about enough. And as you say, that's what you're here for, it's what Sophie's here for, to actually help our clients be aware of it, as well as
Yeah.
all the financial advisors who we work out there around the UK, because it's just yet another case of just policy creep affecting, as I say, nearly 1 million extra people out there.
I just think the fact that so many of our clients ask the question, how much can I pay into my pension, shows how complex it is. It should just be, the ISA allowance, dead easy, 20,000 done. But with pensions, it is far more complex, which is exactly why we've got large teams to take calls, large team of financial advisors, because it can get complex.
Doesn't need to be that complex.
No,
No.
Shouldn't be.
not when you're as clever as you, Tom. That's the thing. Right, next question. I'm going to jump to question 8, because I think this might take us on a more positive spin, which is things have been made a little bit more flexible, haven't they? You can put money in, take money out. So I've withdrawn £3,000 from my ISA. We often see clients who maybe do need to go in and take a little bit of money out, but can put it back in. How much of that can I put back in, and what does this mean for my allowance?
No, that's
You look
fine.
keen, Sophie.
I can take
You
this
were
one,
ready to
that's
take
fine.
that one,
No, you can put it back in, whatever you've withdrawn, if it's within the same tax year, and then your £20,000 allowance, or you can heave it through potential, because we do have a flexible ISA.
Yeah.
It's not the case everywhere, so if you do have ISAs elsewhere as well, I would maybe check before
it's
you
got the
before
flex,
you do
And
go
the-
and make withdrawals. But
And the technology's smart enough to know that somebody's
Oh,
took
it
it out and
is.
put it back in.
it is. It gives you a nice little number when you go. You can even click maximise my ISA allowance, and it'll pop the number in the box for you. So
Yeah.
nice and simple.
I think that's a great feature, actually, because again, when we're talking about, some people may or may not know, the technology is smart enough. When you log in, top up, impulse save, and it'll tell you how much you've used. But also, quite importantly, it doesn't let you go over,
Yeah.
because you can't actually over subscribe into
Yeah.
products. So it gives you that hard stop, which is quite a neat one. So
I think it's where impulse save's nice, though, isn't it?
Yeah.
When plugging the tech too much, you just log into your app. It does exactly what Sophie says. If you've used it before, your debit card's saved. If you haven't used it before, tap your debit card details in once, tick the save box, and it's just there.
yeah,
And you're not having to write a check. You're not having to do a bank transfer. It's just as simple as buying something online as
Yeah.
maximising your allowance on
Exactly.
there.
Yeah, I think that comment that you made about just the fact that not every provider has flexible ISAs, that you wouldn't believe when we obviously go and see look at other providers, the amount of providers that actually don't have a flexible ISA.
yeah.
So it's a real selling point, I think, from our part.
And in their case, once it's out, it's out. You've crystallised it. You've took it out the tax wrapper.
Yeah.
Yeah.
Good benefit of our ISA then, I guess. Yeah.
Yeah.
Tom, I'm going to look to you for the next one. Sorry, and I'm somebody that would like to know the answer to this one as well. So, can I carry forward any allowances into the new tax year? Because I think this is again
Yeah.
something a lot of people ask. I know a lot of the calls the team get is, I've got to the end of the tax year and I wasn't able to maximise everything. What can I move into the next year?
So it all depends on how much you're earning, effectively. And if you're earning over £40,000 a year, then you can.
Right.
So, for instance, if you're earning 60,000, you can take an additional 20,000 on top of your 40,000 allowance that you've got. Now, what you would look to do with carry forward is use this year's allowance and then go back 3 years and utilise some of that allowance. So, you've also got to factor into account tax relief, which I mentioned before. But yeah, carry forward is a really good thing to use, but it is really for the higher earners, the earners above 40,000 that can actually use it.
Yeah. That carry forward's just for pension, though, Tom.
Yeah.
Yeah.
So
ISAs
things
are
like
hard
we
stop.
talked about before, ISAs
Yeah.
are hard stop, JASAs
Yeah.
are the
Yeah.
same.
Yeah.
Probably just a case of speak with one of the team again, because you're talking about going 3 years back, and that sounds quite complex.
We do all the calculations for you. So
Yeah,
if you
exactly.
come into the head office team, we've got like a little letter that we've got, which just looks at all of your contributions that you've made,
Yeah.
what you've used in different tax years and how much you're earning, and we can do all of that for you.
Yeah.
It's certainly something that you need to get advice on that.
No, I think you said it before, Tom. I think pensions are very complicated. I think if you were designing a product today, you wouldn't design a pension.
No.
You look back, you both yourselves, you're smart enough, you've passed all the exams, and you've had to look, past through there, and the amount of kind of archaeological work you're having to do just to explain what a pension looked like 30 years ago versus now is just, it's mind-boggling. And again, kind of something we've tried to lobby about is almost just simplify all the product available to clients, give people a larger ISA allowance, £30,000 or £40,000, and maybe merge that into some sort of pension as well, because I suppose also with a pension, there can be this kind of misnomer that it's never taxed. And a lot of people are shocked then when it turns out you start to draw your pension in the future, you start to pay a bit of income on it.
And to be honest, I think we do a really good job. I think if you compare our pensions in comparison to other providers, which I won't name on here, but some of the older providers, they have ridiculously complex pensions with old sort of weird little bits and bobs of them, and if ours, you can easily and flexibly withdraw from it. You can take your tax-free cash on its own. You don't have to take any income with it, which you do for a lot of providers.
They do it on purpose, Tom. They're old-fashioned, bloated product providers, and actually scoundrels who buy old legacy books, and they make it as difficult as possible to tell our clients or the man or woman in the street what actually their pension does. And you see this, Tom, Sophie, you'll see this when we're dealing with clients and trying to help with pension consolidation. Getting information out of them is like getting blood out of the stone. And when we finally do get that information, we tend to find clients are in lagging products in terms of performance. It's expensive in terms of costs. The benefits and the features, which you're talking about there, are lousy as well. But it's actually a real undercurrent of disgrace, and you're polite enough not to mention the providers, so I'll follow suit with that.
Well, there's a very, very interesting article in the industry press this morning about one of these providers. It was in reading it, you're talking 6 weeks for a response. You're talking six months to get, it's just...
There's one of them advertising on the TV right now with a name of an old product provider, which they bought as well, and don't touch them with a barge pole when it comes to administration. And that's from personal experience, but also the experience of the team here, and helping 3,500 financial advisors around the country try and get information out of that bunch.
Right, let's keep moving, everybody. We'll not name names, we'll not get political, we'll keep on track.
It's because I haven't had any breakfast today, Greg, so my blood sugar's down.
And your anger levels
my anger's up.
So the next one, and we've actually done a really good podcast on this previously, which is the cash ISA versus the stocks and shares, because there's two definitive products there. I've contributed £5,000 into my cash ISA so far this tax year. Can I also put into my stocks and shares ISA?
Do you want to go for this one?
Don't fight over it, guys. I was going to go to Dan with that one, but I think he wants the answer as well.
Sure, Dan.
Well, technically these days there's not a differentiation as well.
There's not as much.
No. used to you could only one or the other.
Yes.
Back in the olden days.
The olden days.
No, you can have both. You can contribute to both, but the allowance is the same. It's all combined, so you can't put 20,000 in one and 20 in the other. So you just have to watch that. Make sure you're not over contributing. But there's, you can have both, but probably best speaking with someone like Tom to see what your needs are. Would you be better in just stocks and shares or just cash, or if you've got both, it might be worth having a word just to see where you should really sit.
My bank, every time I log in now, put a pop-up, put money into cash ISA, and if I'd maxed out an ISA somewhere else, they obviously don't know that, and I think that is quite important, that you don't overstep your allowance.
Great point from Sophie there. Just because you've got 20 in cash doesn't mean you have 20 in stocks.
Correct, and I think it is an important one. And again, I think a number of our clients do have investments with true potential, but they will have naturally investments elsewhere as well.
I think the thing with cash as well is, obviously, I know there is some fairly attractive cash rates at the minute for cash ISAs, but anything that's over 5-year term, you want to be looking at stocks and shares, because that's a longer term where it's outperforming inflation. You've got the best chance of outperforming inflation.
It's inflation, and again, I was asked for a comment just yesterday about annuities, because annuities could look attractive at the moment because interest rates, and interest rates are high, but interest rates, as we know, are artificially high because they're there to temper inflation, as you say. So as inflation goes down, there's an interesting report from Citibank yesterday as well there. Hopefully a bit of optimism for some people, where they're expecting inflation to be close to 2% by year end. What will we see then? We'll see those interest rates rapidly drop. So it's locking yourself into a cash product, or even annuities, and annuities is a whole other subject for a whole other podcast. You should never make a short-term decision based on short-term influences right now, Tom. So you're absolutely right with that. If you want to grow your money 3-5 years plus, it needs to go into something which has a track record of
Yeah.
that growth there, which is stocks.
Just looking through the questions. Sorry, everyone. We've covered a lot, and I'm trying to work out if we answered that one yet, if we not. So
Well, I threw you out, haven't I? Because
totally
I said I wasn't going to speak to you. I'm
and
sorry.
then you got hungry and hungry. as it went on. Tom, a question that's come in. I'm a director of my own limited company, as quite a lot of our clients are. How much can I add into my pension?
Yeah, so it's 40,000 as long as you haven't made any personal contributions. And the difference from if you are a director of your own limited business, I would encourage you to make employer contributions, because what you're benefiting there from is the fact that you lower your national insurance for your company,
Yeah.
you lower your corporation tax, which is going to be even more important next year, and that corporation tax goes up from 19% to 25%. And you know, from our side of things, it'll just, you know, you don't get a tax relief, but you don't pay tax on it when you withdraw from the business. So it's a really good thing to be doing, and the amount you look at is 40,000. You can actually use carry forward as well with that. So yeah, certainly be doing it if you're in that position.
Great, thank you. And then the last question, I'm going to look over this side of the room again, and then I think this probably will wrap it up nicely. It sounds like I'm going to ask you this question, but I'm not. Are my taxes going to go up in the new tax year? That's like a very all-round...
It depends on how much you earn in that time.
Exactly. It's not me asking, remember.
Yeah,
I come here because I enjoy coming. I don't get paid.
I mean, if you're earning over 125,140, then yes, they are going to go up. And for those who have got dividend income and you know, maybe taking some money out of there, something that will provide a capital gain, then yes, taxes will increase a little bit because your allowances are reducing. But for the vast majority of people, things are probably keeping the same.
Yeah, I forgot about the corporation tax sting in the tail. So Greg was laughing as I flinched. As he said, it's going from 19 to 25 as well, which again hits the business owner. So we've talked about dividends hitting, we've talked about corporation tax going up. So I think it is, I think, recycling some of your great advice, Tom. It's make the most of your allowances now. We talk a lot at True Potential about control and making the most of what's in front of you right now, and certainly things are going to get squeezed. I also think lower income people who are paid a lower income, there's going to be a squeeze there as well, because there's some movement with NI and everything as well, isn't there, toward the bottom. But certainly people who are earning, say, £100,000-ish and up there, who tend to be business owners, you're going to get squeezed from all angles. So do make the most of these allowances. The good news is there's lots of time still before April to do so. Tom's not really very busy at the moment.
No,
so there's a lot of
that's why we got him in here.
So he's got a few weeks before April to get it done.
Well, I'll just quickly ask everyone for their one tax year tip, and you're not allowed to say what the person before said. So, Sophie, I'm going to look at you first. A tax year tip.
I would say to check your allowances by using the app on the site, because it's really easy. It means you don't have to keep track of how much you've paid in, and it's what I would be doing.
Yeah, that's a good one. I think mine would be probably just on the basis of what Dan said earlier. If you've got a general investor account and you put money in, obviously, into ISA this year, make sure you get it in early next year, because of the fact that we've had some big, we have had some losses last year, so you can use that to offset, and which means that you're not going above that 6,000 exemption. That's more important for the people who've got quite a lot in general investor accounts, really.
Yeah. I mean, that was mine. It was getting early. It was don't see it as an end, see it as a start, see it as a new beginning, benefit by getting your money in early and getting it almost out the way, not having the mad scramble of checks getting, taken by, taxis. And we've seen it all over the last 15, 16 years of the mad dash. We used to open the building up until
we used to be here till midnight. I remember I used to walk around giving people pizza and things like that.
All sorts, waiting for that madman with a check to come and drop it off and stamp it with the stamper. So, we've come a long way.
Savio's not a madman, by the way.
Another madman.
Yes,
but we had all that kind of stuff going on. Technology's really, as Sophie said, gave us massive advancements to move away from the more archaic ways in which some of our peers and counterparts work still. So And then Dan will let you
Finish with a tip.
finish up with your tip.
I think it's actually linked to taking income, and it's an overall point, by the way. It's not just about tax start or tax end as well, but it's about, we see some of this sometimes where there's a propensity for somebody who's in drawdown and pension to continue to take the same amount out every month. I've taken my £5,000 out every month, and I think use the tax year end, tax year start as a great spring clean of your finances, and say, am I taking too much out of my pension? Am I taking too much out of my ISA? Because once you start to take it out, it collapses. It starts to collapse these tax vehicles, and those allowances, like we've talked about before, then gone. You know, in some cases, not obviously in an ISA, as Sophie says, you can keep it, topping that up, but leave things alone unless you really need the money. If you look, I'll just, very simple in terms of an ISA, that £20,000 in there, it's growing tax-free. You're not paying the corporation tax on the growth if you're in some of those instruments. There's no dividend tax paying in there, there's no income, depending on what you're invested in, which is, again, a whole other subject. But it's growing tax-free from there, as indeed is a pension when it's in that wrapper from there. So it's an overall tip, I think, rather than a tax year end start. But people tend to do exactly what Sophie said before, which is to look at everything at this time of the year and they say, I've got this much, that much there. So don't just think about what have I got to invest. Think about what am I looking to de-invest or disinvest, and is that right?
Thanks, everyone. Really good tips. And I have to ask this one.
Score
You know it's
predictions.
coming. What's everyone doing at the weekend?
Well, tomorrow I'm going to Durham to take my daughter to the passport office.
That sounds like a
Yeah.
lovely day. Anything else exciting at the weekend?
I don't think. I'm going to bike riding Sunday morning.
Lovely.
Yeah.
Tom?
I'm going to watch Newcastle get beat.
Oh,
You're a Leeds fan.
I know.
You're meant to support Newcastle against Manchester.
it's like a rock and a
Yeah.
hard
I
place
know,
for
it's
you.
actually really hard. But it's
As-
like,
as a
I'm going to have
Leeds
to listen
fan-
to you lot when I come in. Man United.
You was not. You've lived here a long time now, Tom. You're
I am
almost
from the north.
almost a Geordie.
I do hope you win, actually.
Yeah.
Just because I think it'd be good for the North East.
Thanks, Tom. And Sophie.
I'm going to watch Newcastle win.
Oh,
And if they don't,
Yeah.
you know,
You're
who's
from
to
my neck
blame?
of the woods. You shouldn't be supporting Newcastle.
Always supported Newcastle.
Always
Should be
since.
the right answer. Yes. Greg, what are you doing?
Well, Daniel, I'm glad you asked. I will be going to watch my beloved Newcastle United playing at Wembley. So very much looking forward to it. I'm not going to give a score prediction, which Graham over there asked me to do, because as I know this has been recorded
Yeah.
and will be thrown in my face if I get it wrong. So I wish both teams the very best, and I hope the team in black and white win.
Agreed.
But football is always the winner.
Football is the winner.
Football is the
The
winner.
spirit of competition.
Correct. So, ladies and gents, thank you for staying with us this long. I hope the team have gave you some real insights to tax year reset, as we'll call it now, Tom. So thank you for that one. As always, please do remember to like and to also subscribe for more content from True Potential. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.